Good evening, everyone, and welcome to tonight's webinar, Understanding Student Loan Repayment and Residency Loans. My name is Linda K. Tyler, and I am the Director of Business Development for ASDA. I am pleased to welcome PNC Bank as the sponsor of this programming. We're glad you've joined us at this evening as we have a very informative and interactive presentation planned for you. During the presentation, we do encourage you to submit questions in the Q&A feature. Now, I would like to welcome our presenters from PNC Bank, Jeff Recker and Steve Elias. Jeff is the Vice President of Campus Relations Manager at PNC Bank Student Lending. He has 25 years of experience in helping students and their families navigate the complexities of financing higher education. Jeff is also versed in financial literacy and is mindful of long-term success both in and beyond the classroom. Steve Elias is also a vice president of campus relations manager at PNC Bank Student Lending, and he too brings extensive expertise in guiding students and their families through the complexities of financing higher learning. With a strong foundation in financial aid and student lending, he possesses a unique blend of technical knowledge and personal insight into the financing needs of students at every stage of their academic journey. It is my pleasure, and I hope it is yours as well, to join me in welcoming both Jeff and Steve.
Thank you, Linda. I really appreciate the introduction, the kind introduction for Steve and myself. Welcome, everybody. Welcome, ASDA. We're thrilled, absolutely thrilled to be here on this call. And as Linda mentioned, we're here for the presentation for understanding student loan repayment and residency loans. We're going to move right. Well, there's a picture of Steve and myself. For future reference. Perhaps when you're going back and taking a look at the presentation, you'll remember who we are, and it might jar some thoughts, some memories of the presentation. So today, the purpose of this presentation is to provide you insight to student loans and repayment options. And so hopefully by the end, you should have a better understanding of the following: repayment of federal and private student loans, and to determine if extending repayment, consolidating, or refinancing student loans is in your best interest, to decide if a residency loan is a consideration, and to utilize newly learned strategies and tips for successfully repaying student loans. So as Linda mentioned, we do encourage questions during the presentation. So what you'll want to do is just type your question into the Q&A box and hit send. And the questions will be addressed in the order that they are received. Again, please feel free to type those questions in. If too many come in, then we do have time at the end of the presentation to answer more questions. So today, Steve and I put together this agenda. The first, of course, is understanding student loan repayment, meaning exploring the federal versus private student loans. The second point on here is federal student loan repayment options. Third, federal consolidation. Fourth, private student loan refinance. And we did put together a glossary of student loan terms. As we understand, this is kind of a unique space, and uh, we don't expect that everybody understands all of the different student loan terms that are out there. And then tips for repaying your student loans. From there, we'll move into residency loans. And finally, we put together some additional resources for you. And again, as I mentioned, we'll have time at the end of the presentation to address any Q&A that we didn't get around to during the meat of the presentation. So during this presentation, we also put together some polling questions. And we'd like you to participate in this because this will give us a better idea of who our audience is, and that way we can uh, you know we can address the questions in a more meaningful way. So the first polling question that we have is, what year in dental school are you? And we're going to give you about 30 seconds to type in your answer. Okay, thank you. All right, this is great. So it looks like we have just about every year represented. Certainly, there's a few more of the D3s and the D4s. All of this is wonderful because this presentation actually has a little bit of something for everyone. The nice thing is we'll be talking about in-school loans, residency loans, and of course, once you're out and you're looking to possibly refinance. So thank you for that. Okay. Well, this seems to be stuck right now. I apologize. I wonder if it was something to do with the polling question. Give me 1 second. Figure this out. Well, my laptop is actually stuck on this screen, so my apologies. Steve, I don't know if you're able to bring yours up. There we go. Okay. Well, again, my apologies for that. Sometimes technology gets in the way often. Okay, so the first slide I really want to dive into is understanding student loan types. And the difference between federal student loans and private student loans, and most of you probably have a pretty good idea of what those are. Certainly, if well, if you've been in school and you've taken out loans, most of you have taken out federal student loans, and of course, these are the loans that are offered by the government. They're fixed interest rates. They have flexible repayment plans, and they have benefits like public service loan forgiveness as opposed to private student loans, which are issued by banks and credit unions and other lenders. And they can have fixed or variable interest rates. And these may be based on income or credit qualifications. In fact, they always are. I do want to take a second and talk about this slide a little bit because it's very, very important. Um, you want to truly understand the differences between the two and which option might be best for you. So a few things to consider when comparing federal loans versus private loans. Generally, federal loans, as I mentioned, they'll have better repayment options, again, like public service loan forgiveness, deferment, forbearance, and income-driven repayment plans. However, there are some things to consider when you're looking at a federal loan. For example, Grad Plus charges a 4% origination fee. And when you're looking at a private loan, you'll never really be charged an origination fee. I'm not aware of any private lenders that charge an origination fee. So as dental students, your loans are typically fairly large. So this 4%, that can be pretty substantial. So unless you know that you're going into public service and are hoping to qualify for public service loan forgiveness, you really should consider a private loan just based on that alone. Um, and if I may, the reality is dental students, you're the cream of the crop when it comes to repaying your loans. Lenders absolutely love you. So students in no other program repay their loans better than dental students. And unfortunately, the government offers the same rate to all grad students, regardless of their field of study. The current interest rate on a Grad Plus loan is over 9%. So in theory, um, since every grad student gets the same interest rate, in theory, someone is basically subsidizing somebody else, which is why you should take a look at private loans because you may qualify for a better rate. And so most lenders, including PNC Bank, we offer a soft credit pull. So before you accept that Grad Plus loan on your award letter, I'd recommend exploring what your interest rate would be like with a private loan. So now this is really important. If you like what you see, meaning if you apply for a loan, you get that soft credit pull, and you apply for a loan and you see your interest rate, you'd actually need to decline the Grad Plus loan on your award letter. So just a note, your school will always award a federal loan and never a private loan. So that's really up to you to take charge. So a little bit of information there. I want to know if anybody has any questions on that before we move on. Okay. I'm going to turn this over to Steve for the time being, and I'll come back in a little bit.
Thank you, Jeff, and good evening to everyone joining us. Thank you again. I want to spend a little bit of time talking about federal student loan repayment. And you may have heard recently in the media or through your financial aid office that there have been some recent court actions that are currently putting a pause on some of student loan repayment options. And some of these cases are intended to be decided probably sometime in September. So it's going to be a little while longer before everything is really hashed out on what's happening. But there is a federal court-issued injunction preventing the Department of Education from implementing the SAVE plan and parts of other income-driven repayment plans. As a result, the income-driven repayment plans and online consolidation applications are temporarily unavailable. Borrowers can still submit a paper consolidation application at studentaid.gov. And even within the past couple of days, there have been some additional ramifications of some of these court cases and some of what is going on with the Department of Education. There has been some additional things affecting the public service loan forgiveness as well. So students may be put on hold for that depending upon your situation currently as well, where none of you are probably in repayment it doesn't directly affect you yet. As always, we do strongly encourage you to seek out the most up-to-date information, either from the Department of Education through their website, studentaid.gov, or your student loan servicer that has been assigned to you for your federal loans, and also your financial aid office. And for those of you in dental school, most of you probably had a different undergraduate school from dental school. And you can certainly seek advice from either financial aid office, either your current dental school and or your undergraduate school as well. And that's something you can actually do through the life of your loan, through all of repayment. Never hesitate to reach back out to your undergraduate or dental school after you have left if you have any repayment questions. And the financial aid office will generally always be able to assist you and will certainly have the most up-to-date information. And we can go on to the next slide, please, Jeff.
Okay. Again, my apologies. This presentation is sticking. While I'm figuring this out, we do have a couple questions, and I think that we'll go ahead and take those now while I'm busy trying to advance the presentation. One comes from Henry asks, is the interest rate on Grad Plus loan for the life of the loan amount? And the answer is yes, unless of course you opt for a variable rate. Oh, I'm sorry. On the Grad Plus loan, it is because it's fixed. So it's always going to be yes. And Elizabeth wants to know, what is the rate on a private loan? It just depends on your credit worthiness. So when you apply for a loan, you'll receive your interest rate. The other one I have is, if you take a private loan, would you have to start making payments while in school? The answer is no, unless you choose to. Private loans will always have, any in-school loan will always have a grace period. And the last one I have is, would the high interest from a private loan go over the origination fee for the federal loan? So that's an interesting question. There's a good chance that your interest rate from a private loan will actually be less than the interest rate from a federal loan. We obviously can't guarantee that. But again, lenders, we really, really like dental students because you're most likely to repay your loans. And generally, you will get a better loan than the Grad Plus rate.
Now I want to go on and talk about some of the various federal student loan repayment options. And the first one is standard repayment. And this has a 10-year term. Unless it's a consolidation loan, then it would be 30 years. It offers fixed monthly payments, so your payments would always be the same month by month. And this is generally considered best for borrowers who can afford higher payments and want to pay off their loans quickly. In general, the quicker you pay off your loan, the less you pay overall. So paying quicker saves you over time. However, many borrowers are concerned, especially during the beginning of their professional career, on having affordable monthly payments. And we'll see that as we go on. The next type is graduate repayment. And this
Steven,
again is for 10 years with
Steve,
30. Yes.
this is Linda. I just want to interrupt. What we're seeing on the screen is the poll. So we're not seeing the actual presentation. The students aren't seeing the presentation.
Okay, excuse me for a moment.
And there it is. Now we can see your presentation. And it's right now, it's on federal student loan repayment.
Actually, I think this is Jeff's screen again.
And it is stuck on this screen. Steve, are you able to share your screen by chance?
I'm sharing mine.
You are. Okay.
Excellent.
No,
Thank you, Linda.
I'll stop sharing. There we go. There we go.
So
Perfect. Thank you, Linda.
you're welcome.
So Linda, if we could just go up a few slides. Up again. One more, I believe, or two more.
I'm already at the glossary of student terms.
Yeah, it should be before
Yeah, keep
that.
going. Keep going.
Understanding student loans.
It's actually several more, Linda. If you go forward one, Linda, please. Whoops.
Right there.
Um, Forward one more. Yeah, thank you.
You're welcome.
This is, I apologize for that, folks. The graduated repayment plan, which also is for 10 years or 30 years if it's consolidation. With this program, payments start low and then increase every 2 years. The assumption is they increase as your income is increasing during your career. And this is best for borrowers with who have income that is expected to grow over time. We could go on to the next slide, please. Now we have income-driven repayment plans, and this is designed for borrowers with low income relative to their debt. Monthly payments are based on income and family size, and there are 4 types of income-driven repayment. And as a reminder, as I said earlier, a federal court has issued an injunction preventing the Department of Education from implementing parts of the SAVE plan as well as IDR plans. And the IDR plans are income-based repayment, which is based upon 10 to 15% of discretionary income, and then it features loan forgiveness after 20 to 25 years of repayment. So with all of these income-driven repayment plans, borrowers would be documenting on an annual basis what their income is. These days, there are links directly between the IRS and the Department of Education to do that for most borrowers. We also have pay as you earn, and this features 10% of discretionary income, and then any amount not paid off after 20 years of payment is forgiven. Then we have revised pay as you earn, which features 10% of discretionary income, and then there's loan forgiveness after 20 to 25 years. And lastly, under the income-driven repayment programs, we have income contingent repayment. And this is based on 20% of discretionary income, or else it can be a fixed 12-year plan if the borrower so chooses. And then there's loan forgiveness after 25 years with this program. We could move on, Linda. And we have another poll question. And now we're asking, what is your student loan borrowing? And if you could enter your answer for either none, undergraduate only, dental school only, or both undergraduate and dental school. So we'll give you a few moments to register your answers. And we can see, based upon the answers, a few of you have no loan, so congratulations, great for you. A select number have undergraduate only loans. Many of you have dental school only loans, and a fair amount of the audience has both undergraduate as well as dental school loans. So we certainly appreciate you um, responding to that question as well. That's certainly helpful. I'll go ahead as well and look at the chat, I should say at the question and answers. One question we have is, um, what is a consolidation loan? And we're going to actually be addressing that very shortly. So we'll cover it shortly for you. How do you go about applying for private loans? You can apply through any private lender who offers private loans. Colleges are required to process private loans from any private lender you choose. Many colleges have what's called a preferred lender list, and we suggest checking with your school's financial aid office to see what lenders they have that they work well with and that have been offering good customer service to current students or past students, and your financial aid office will be able to assist you with a list of lenders. But again, you're free to choose any lender that you want. And then we have one last question. I'm currently doing a GPR. Is IDR the best plan to have? In general, what I would suggest you want to do, the federal government, um, through their website and through their student loan replicator, they actually have a great way for you to enter all of your loan information, and they really pull that in for you because they have those records. And then they'll be able to help you run some models to see which program is actually best for you and your situation. They ask things about expected income and sort of what your plans are after school, and then taking into account your debt. And they are pretty good about being able to letting you know what sample repayments would be on under most of the repayment options. And that way you can select which is ideally best for you. As promised, we're going to go on and talk a little bit about federal loan consolidation. And consolidation is a process of combining two or more federal loans into one new federal loan with a single monthly payment. And that's certainly helpful in managing your student loan repayment. Maybe you borrowed for 4 years of undergraduate and 4 years of dental school. So in reality, you would have 8 separate loans, and consolidation is a way to combine them all into one and make the repayment process much easier, repaying a single monthly loan instead of multiples of 8 loans on a monthly basis. Consolidation can help lower your monthly payment by giving you a longer time to repay. Up to 30 years for the federal loans can be utilized under the consolidation program. So again, it helps you lower that monthly payment to make it manageable. And the great thing is with federal loans, and for that matter, all private loans as well, you can prepay at any time without penalty. So you could start out trying to have the lowest monthly payment so that your payments are affordable while you're a new dentist. And then as you go on in your career and hopefully your income continues to grow, you could either, accelerate your payments, or some students pay off their loans much sooner as their career goes on. Then, let's say you signed up for consolidation with 30 years. Maybe in reality, you pay it off in 15 or 20 years, for example. And the fixed interest rate would be based on the weighted average of all of the loans that you chose to consolidate. And if you borrowed as an undergrad each year and also as a dental student, your interest rates can vary widely. They've certainly gone up quite a bit in the last few years compared to where they were 6, 7, or 8 years ago. So you'll get a blended interest rate if you consolidate. You can consolidate during your grace period after graduation or leaving school, during periods of deferment or forbearance, or you could consolidate at any time once you've entered repayment. Information on applying for consolidation and additional details on consolidation are available on the federal government's website. Again, they've stopped taking applications online, but you still could submit a paper application until things are settled out with the ongoing law cases. We could move. Thank you, Linda. I also want to talk about some other things related to federal loans. As we already talked about, public service loan forgiveness, and that is where the remaining balance after 10 years of repayment under an income-driven repayment plan has been satisfied, then the remaining balance would be forgiven by the federal government. And again, the income-driven repayment plans are currently on hold as well, based on some of the pending law cases that are out there. But it's certainly a great option for those of you who have plans to go into working in either the government or nonprofit. And many health professionals across the country do benefit from public service loan forgiveness. One thing I just want to make you aware of, there are also some processes in play that might change what qualifies as public service loan forgiveness, which employers would qualify. Some of the things that they're considering is changing the way hospitals are looked at, even nonprofit hospitals, for public service loan forgiveness. So keep that in mind. And nothing is definite yet, but there has been some talk about that changing. There's also the health profession student loans, and these are loans offered by Health Resources and Services Administration. And schools actually apply for these loans, and then they award them to students based upon the FAFSA. And because of this, not every school has them available to offer. However, if your school does offer them and you qualify, these loans come with some unique borrower benefits, including lower interest rates and longer grace periods. So they're certainly an advantageous loan to qualify for if you do. Additionally, we have loans for disadvantaged students, and these are for full-time students from disadvantaged backgrounds as defined by the U.S. Department of Health and Human Services. So you can see too, it's not just the Department of Education that affects some of the loans that you may qualify for. It could also be some other federal departments as well.
And then Steve, before
Yes.
we move on, we have a few questions. The first is, how often can you refinance your private loans? And that really depends on your lender. At PNC Bank, you can refinance as many times as you'd like. Some private lenders will only let you refinance once. The second question is, if you consolidate federal loans, they are no longer eligible for public service forgiveness options, and that is correct. Once you consolidate, that's kind of you won't be eligible for loan forgiveness. And then the third is, would consolidation have any drawbacks, such as making you ineligible for repayment forgiveness programs? And a very similar question, and that would be the case, is that you would not be eligible for forgiveness programs. And that's it for the questions right now.
Thank you, Jeff.
Mm-hmm. Okay. It looks like this is my slide. So Steve, thank you so much for your insight. Steve, in addition to being having all of the years in this industry, he worked as a financial aid director at a college for a long time. So he has some really great valuable insight as to the federal loans. So let's talk about refinance for a minute. so I think Steve alluded to this when he was speaking, but nobody can predict what interest rates will do. For a very long time, we saw historically low rates, and then COVID hit, and we all saw them creep up to what they are today. So as the economy has cooled a bit, many experts they're expecting that they might recede a bit, but again, nobody really knows. But if that does happen, refinancing your loans can literally save you tens of thousands of dollars over the life of the loan. So one thing to ask your lender is, and this came up in the questions, is how many times can you refinance with them? With PNC Bank, you can refinance an unlimited amount of times. So, but why refinance? Well, the biggest one is lower interest rates typically. During this time when interest rates have been really high, we've seen very few people refinance their loans. Typically, when interest rates are low, certainly lower than what the government offers on the federal loans, we'll see a lot of borrowers refinance their loans. So yeah, so lower interest rates, consolidate multiple loans, or shorten repayment terms. And of course, there are risks because you'll lose your federal benefits such as deferment, forbearance, or loan forgiveness. And then you want to consider what lender you want to choose. You'll want to compare fixed versus variable rates, fees, and lender reputation, of course. And PNC Bank, we offer a lot of tools and calculators for refinancing decisions, and you can visit pnconcampus.com for more information on that. And Linda, you can move on. I think we have another poll question coming up. We do. And by the way, this is all your answers are completely anonymous on this. So we want you to, we just want to know how much in total student loan debt that you have. And we'll open this up for about 30 seconds so you can answer. Okay. Well, about 7% have zero. So congrats again. And this kind of mirrors the last poll question that we had. It looks like most 27% have between $200,000 and $300,000 in student loan debt, which is actually really typical. So the average indebtedness of dental students, last time I looked, was about $289,000. And that's actually before any specialty if you're planning to go into one. But again, dental students are more likely to pay off their loans than any other program. So I know that that's a big number, but at the same time, history shows that you will pay off your loans. So that is the good news there. And Linda, if you want to move on to the next slide. Okay, so student loans, of course, they can be confusing. Some of our terms are probably not in your vernacular, so we included some key ones in this presentation. And I'm not going to go through every single one of them, but for example, the first one we list here is APR. And of course, when you're talking about APR, you always want to compare it to the interest rate. And for those of you who don't know what an APR is as compared to an interest rate, an APR is basically that interest rate plus any fees. So that's just a simple way to think about it. The next one down here, which I think is really important, is capitalization. So that's your accrued interest. It's added to the principal balance, which will increase your overall balance. And if you think about this, most of you probably have loans that are they're not subsidized, meaning the government is not paying the interest. So all of that interest is accruing as we speak. And at some point, that'll be added on to your principal balance. Then that's how it'll increase your overall balance. Some other things on here that are important are deferment and forbearance, which are very similar. Sometimes the two get mixed up a bit, but deferment is a temporary postponement of payment on a loan that is allowed under certain conditions. And if you think about when COVID hit, all of your loans were deferred. You didn't have to pay on those until the government told you that you had to start repaying them. Forbearance is a term that we use a lot in banking, and it allows a borrower to temporarily stop making monthly student loan payments or make smaller payments. So private lender options for forbearance depend on the loan servicer's policies and such, but typically when you're speaking about private loans, you're speaking about forbearance, and when you're speaking about federal loans, you're speaking about deferment. And Linda, you can move on to the next slide, please. And I think there was a question earlier about grace period. And with private loans or federal loans, you're going to have a grace period. And that's the time before the borrower is required to begin making payments. And usually that grace period is about 6 months. Any others on here? I think that's probably it for that. Let me see. There is a question. Can you unconsolidate your loans? That's a great question, and the answer is no, because it's a legal and binding contract. So once you consolidate, you've entered into that contract. It's a good question. I've never gotten that one before. Okay, Linda, we can move on now to the next slide, please. Okay, so here's just some basic tips for repaying your student loans. And, some of these are pretty obvious, but I am going to read down through the list. So keeping documentation of all your student loans is really, really important. And if you're speaking with your servicer, you want to document who you spoke to and when. So my advice is that you set up a student loan file and know who your loan servicers are. And if you don't, they'll reach out to you. They're very, very good about doing that. Consider all repayment options. Have that conversation with your loan servicer, and they're wonderful. They'll be able to help you through. Never be afraid of your loan servicer because they are there to help you. So you want to constantly evaluate your repayment objectives and repayment plan, and then change if needed. And this seems really obvious, but you want to open your mail and read all correspondence from your lender or servicer. Obviously, you want to make all regularly scheduled payments. And of course, you want to notify your servicer early if you're not able to make your scheduled payments. I think it's human nature to kind of shy away from a difficult situation at times. So what happens with a lot of loan servicers is that when somebody gets behind on their payments, they never hear from them again, which is unfortunate because they really do have a lot of great options for you. They have a lot of great answers for you. So if you're struggling to make your loan payments, don't be shy. Reach out to your loan servicer and have that conversation because that's really, really important. And then you'll want to consider setting up an auto pay to ensure on-time payments. Many private loans offer an interest rate reduction for auto pay. And I can give you an example. I think I'm not aware of any lenders that don't offer some sort of incentive for auto pay. Usually it's 0.25%. Here at PNC Bank, we actually offer 0.5%. So definitely set up on auto pay if you can do that. And then you want to keep your contact information current. Again, obvious, but you'd be surprised at how many people let that lapse. And finally, there's no penalties for paying off your student loans early. If you can do that, that's wonderful. But that's a question that comes up every now and then is, am I going to get penalized if I want to pay my loan off early? And the answer is no. And Linda, you can move on. And here we have, I think this is our final poll question. Do you plan on participating in a residency after dental school? We'll give you a couple more seconds to answer. Okay, 38% said yes and 62% said no. So we'll close that. And Linda, if you want to move on to the next slide. which is a nice lead-in to residency loans. So residency loans, there's only a couple lenders that actually offer residency loans. It's PNC Bank, us, and Sally Mae, and I'm not actually aware of any other lenders, private lenders, that is, that offer residency loans. For residency loans, they're specialized student loans designed for dental, medical, and basically any other healthcare students who need financial support during their residency or fellowship. So these loans, they're designed to help cover living expenses, relocation costs, and exam fees, as residents typically earn lower salaries while completing their training. So just so you know that these loans do exist, because we know that transition time is very difficult. And again, these loans can be repaid right away, or you can defer them until you're until you're out, or until you're in your practice or and such. So, Steve, was there anything else you wanted to add during residency loans?
No, Jeff, that covers it. And again, for those students who do need some additional assistance as you moving on to the next stage of your professional career, your residency, sometimes having these funds available can help, bridge between in school and into your residency.
Fantastic. And Linda, you can move on to the next slide. Oh, we do have one question. What are the interest rates for residency loans? Are they about the same as other loans? That's a great question. So interest rates, again, they're going to depend on your credit worthiness. Uh, so, uh, and I'm sorry, okay.
To give you an idea, for PNC, one of the two lenders offering residency loans, the interest rate is between the high fours all the way up to the high 12 or 13%. And again, these are credit based, so it depends where your credit would fall. One thing we didn't talk about yet for in-school loans, even though you're a dental school students, it is possible to still have a cosigner for your private loans. And what a cosigner can help even a dental student do, although you very well may have established credit on your own, having a credit-worthy cosigner, if their credit is very favorable, can help you get a lower interest rate, or for those students who may not have enough credit established on their own, having a cosigner could help you qualify for these in-school and residency loans. And sometimes that is the case even for refinance loans. Sometimes when you're just starting your professional career, you may or may not have enough established credit to qualify for the refinance loan on your own. And PNC, like most private lenders, offer cosigner release options. So after a certain number of on-time payments, you could apply to have your cosigner removed from the loan. And then if you qualify based on your credit at that time, then it would legally become only your loan and the cosigner would no longer be obligated for that loan.
Yeah, thanks for mentioning that, Steve. I think that about 90% of applications that come through our door have a cosigner. So we obviously encourage that for all the reasons that Steve just mentioned. Um, so we do have some more questions. I'm gonna table those for a second because we have 10 minutes left, and we actually are coming to the end of the slide presentation. These are just some additional resources and references that Steve and I put together for you. You can see, like on the second bullet point, there is PNC's website, so you can come to that site, and we have a plethora of information for you to to peruse. So, Linda, if you want to move on, I think that is it. So let's pull up the questions, and we have 10 minutes to answer those. Steve, the first one, I'm going to defer to you on this. Can I start my payments as IDR and switch to a regular 10-year repayment plan after?
Generally, once you've picked a repayment, you're going to want to stay in it. Again, you can prepay at any time without penalty. So generally, you would stay in that repayment. If you have new loans added on, if you end up going back for further degrees or additional studies, even in dentistry, then that will change things if you have new loans. But again, you can always prepay at any time without penalty. And really, the income-driven repayments are really there to help you most during the early part of your career. And then as you go on, um, again, these are based on your income. So your income's going to be higher. So it'll be the same percentage year that they look at, but it'll be a higher income that that percent is taken from. So your payments would naturally go up anyway. And sometimes in that, you actually end up lowering your repayment term if your income goes up enough where you're paying off more sooner, then you don't end up having the full repayment period in some cases.
Steve, the next question we have is, will I need to start repayment on my dental school Fed loan while in residency?
No, the loans are deferred while you're in school and during a residency. You would just have to make sure that you document your residency to your servicer. What happens these days is when you're in actual dental school, the registrar's office at your dental school automatically electronically communicates with the Department of Education's system and tells them that you're in school at least half time. You do have to be in school at least half time to get the in-school deferment. When you're in a residency, it's not as clean, the reporting. It really depends what program you're in. So you're going to want to make sure you reach out to your servicer to make sure they have the most up-to-date information. And in some cases, they may need you to document that you're in that residency.
Steve, next question is, what are the best loan options for the transition time after you graduate up until you start working or find a job?
Sure. And the loans themselves, the regular federal loans and most private loans have a 6 month grace period after graduation or leaving school. One thing you want to be cognizant of, you only get one grace period per loan. So on your undergraduate loans, for example, if you did not go right into dental school from undergraduate and you are working, after your undergrad degree for a while, then you probably exhausted that 6 month grace period for your undergraduate loans. You don't get a new 6 months on those loans when you finish dental school. So those loans actually will become due within about 30 days after graduation. Many of you, though, probably went right from undergrad and then started either in the summer or the following fall in dental school. And then you should have had enough continuation time to really not utilize that undergraduate grace period because you're in an in-school deferment on those loans, being in dental school. But you sort of want to clarify that with your servicer. If it goes past the 6 months on both federal and private loans and you aren't having income to support these loans, I would suggest contacting your lender or servicer, both on the federal side and the private side. And they can usually offer you a forbearance, either a full temporarily stopping the payments or possibly lowering the payments, depending upon what your work and income situation is for a period of time. Most private lenders have restrictions on how long that can go, but many of them do allow you to get multiple ones. It might be 6 months or 9 months or a year, and then you could get a second one. But after that, you'd really want to work with them to see if they could go further. On the federal side, there would be forbearances as well that the federal government could offer if you're having difficulty. And as Jeff said in the tips portion, you really want to contact your lender or servicer as soon as you know there's going to be some issues with making those payments, especially the first time it happens and as close as it could be to graduation. Most lenders on the federal side, the federal government, as well as the private lenders, are very good about working with you and understand it can take more than you would like to maybe get that job.
Excellent. The next question, and we have about 8 questions, so hopefully we'll be able to get to those in the next 4 minutes. You said autopay gets how much deduction on rate with PNC, and what sort of origination fees are there for refi? I can certainly take this. PNC offers a half a percentage point for autopay, and then there's never we're never going to charge an origination fee for refi. I'm not aware of any private lenders that actually do. So the next question is, do private lenders mind taking a loan out for each term of dental school, which is 6 months, resulting in multiple loans? Um,
I can take that one, Jeff.
oh, sure.
And
Go
that's
ahead.
that's a great question.
Mhm.
Generally, it's recommended you borrow once for the full academic year because that just limits the number of loans you have and the number of payments you need to make unless you refinance. But you could do that. You could borrow by semester. It involves additional loan applications as well as additional payments over the life of the loan. So it's generally recommended you borrow once per academic year.
Indeed. The next question is, what's the refi time frames PNC has available? And you're actually spot on. It's 5, 10, and 15 years.
And 20 for those
And
with really high debt, which many of the dental students qualify for. So we do give those with the highest debt an additional 5 years of repayment.
indeed. Next question. Many students go into practice after school, then after a few years go to residency. Can you pause repayment after you have started payback for residency?
You can. Certainly, again, you want to, if you have federal loans, you want to check with your federal loan servicer, and they probably will need documentation of that residency. The private loans, it's not something that's automatic if it's not directly after dental school, but most lenders would work with you. And as long as you could document that you're in an approved residency program, I would imagine most lenders would be able to give you that additional time to complete your residency.
Excellent. A couple more questions. I can only start my residency 1 year after graduation. Do I need to start to pay the graduate loan after the 6 months grace period? And will it stop when I start the residency?
Another great question.
Mhm.
And if you've graduated and the 6 month grace period is over, you will need to begin paying off your loans, both federal and private, in the interim if there's more time before you um, start a residency program or something like that. So there would be a short period of time that you would be in repayment. And then once you document you're in your residency, most private lenders in the federal government would allow you to go back into deferment during that residency. But again, you want to work closely with your loan servicers to make sure that's all happening and the documentation's being given. The last thing you want to do is not making sure that all of those loose ends are tied up and then inadvertently going into default or delinquency on your loans, because that will certainly negatively affect your credit history, especially if you want to go into practice for yourself eventually and take out loans for businesses and those kinds of things. So the best thing is be proactive and be upfront, and most services will work with you.
Linda, we still have more questions. I'm wondering
Yes,
if,
I was going to say, I would say take two more questions and then we'll wrap up.
okay, sounds good.
Thank you.
Um, this looks like it's a follow-up question. Thank you. What I mean is, what are the options to get additional loans during that period if you need that extra assistance? And I'm assuming this was the question on the transition to residency. There's, I
If
apologize. There's been, yeah,
if
go
you're
ahead.
in residency, then you can use a residency loan. If it's transition to employment, there really aren't any student loans that you could take out additionally after graduation. But definitely contact your servicer to see if there's anything they can do to help give you some additional time.
And
All right.
one final question.
Yes. Are there any qualifying criteria for refinancing of private loans? And again, this I can certainly take this. This would certainly be for this would be your credit worthiness, but also we would absolutely recommend getting a cosigner as well, and that'll certainly help get you approved for that loan. But the residency loan is just like any other loan. They'll take a look at your credit worthiness to determine, what your interest rate would be and if you're approved. Linda, is there any way, like if people have questions after this presentation, if they can get those to you and then we can answer those in due
Absolutely.
time?
So, I want to thank you both for joining us and thank you for providing that information. Very timely and very important. I want to thank our students for joining us tonight. I know it's been a long day, so we appreciate that you've joined us for this webinar. And just so you know, this webinar will be saved and you will have an opportunity to view it again. It will post in 1 week on ASDA's YouTube channel, and then it'll be saved to our webinar directory at asdanet.org. For those questions that you may have regarding student loans, please do not hesitate to contact myself at linda@asdanet.org. That's linda@asdanet.org. And I'll make sure that I get those questions answered for you. Jeff and Steve, thank you both for joining us tonight. Thank you for your insight, and we do appreciate it.
Thank you so much.
Thank you.
Good night, everyone.